Look, as always, I'll start off doing my best just to say a few words on the big picture, and then I'll talk a little bit about what we're seeing in our portfolio today. As Emma said, we put a lot of work into the annual report letter, so there's a lot of detailed case studies in that. We didn't think we'd sort of rehash that, but rather more productive would be looking ahead. What are we seeing out into the future? But just starting with the market and maybe starting with an observation. We are a year and a half now into this arrival of COVID-19 into our lives, the worst global health crisis in a century, a disease that's killed 20 million people. Here in the developed world, it's completely upended our normal lives. We're all horrendously frustrated with it all. In the developing world, it's pushed something like 120 million people back below the poverty line. Yet, if you're an investor in just about anything other than cash during this period, it's probably been one of the best investment periods of your life. And that disconnect between the real world and the investment world is something I think is just worth touching on for a minute. The driving force behind all of this, behind all of the wonderful gains we've been making recently, whether it's Australian property or share markets or even new asset classes like Bitcoin, the driving force behind all of that has been the falling cost of money. Money today is cheaper than it's ever been. There are enormous amounts of it sloshing around the system just trying to find a home. And more than anything, that's what's been pushing asset prices higher since the pandemic began. And while that dynamic's been really pronounced for the last, say, year and a half, it's something that, investors have enjoyed now for a good 30 years. We've all enjoyed this steady drumbeat of interest rates falling lower and lower, pushing asset prices higher and higher. And hopefully that's something I can actually illustrate on this chart.
Yes.
The navy line on this chart, there we go. The navy line on this chart shows the yield on the US 10-year government bonds. It's a key interest rate benchmark all around the world. You can see that follows a pretty sharp line from the top left down to the bottom right. While the grey line here shows the cyclically adjusted price to earnings ratio, this is a grey line now, of the price to earnings ratio of the S&P 500. You pop the grey line.
Yeah.
Right, there we go. The navy line essentially shows how cheap or expensive money is around the world. The blue line shows how cheap or expensive money is effectively, while the grey line shows how much people are willing to pay for future company earnings. So you take a bit of smoothing out. There have been a few hiccups along the road, obviously. We had the dot-com bubble in the early noughties where valuations shot very high for a short period of time and then rather spectacularly unwound. And then more recently, the two big market corrections we've had, the GFC and the pandemic crash last year. During those periods, in the scheme of things, for very relatively short period of time, valuations fell down briefly. But if you kind of look through those three bubbles, you can see a pretty lockstep relationship. As the cost of money has fallen, the value of asset prices have risen. And that is a truism of finance. So, as the cost of money falls, how much you can pay for assets by definition increases. We've all benefited from this for so long now. It's probably a bit hard to imagine a world where asset prices don't just always go up, even after we've had things like a devastating pandemic. Obviously, the inverse of this relationship holds true. Asset prices fall when the cost of money starts to rise. Now, if you wanted to make a rather scary picture about the outlook, and it's a narrative that you do hear in the market from time to time, you can make an argument, that we've hit the end of the road of this free ride, this big tailwind we've had for the last 30 years. Interest rates today have to be kind of as low as they can go. Governments just can't afford to keep spending money on stimulus the way they have been through the pandemic. The taps have to be turned off at some point. And most worryingly, we're probably all seeing some signs of inflation, possibly even high inflation, creep into the system, which is, of course, the sort of thing that gets central banks lifting interest rates again. That doom and gloom argument certainly exists, and it's something we have to keep a real eye on. We're probably not as pessimistic about as that, but I guess I'd say we do have a few concerns. They're a little bit more subtle, however. The first is, when we look at the world today and the big inflation debate that's raging on, it's really a debate about whether this uptick we've seen in inflation is a sustainable thing or whether it's transitory. In truth, nobody knows. If we were forced to make a bet, we'd probably say it's a little bit of both, meaning that it's probably the case if inflation falls back down a little bit, and that probably means interest rates can continue to bumble along right at the bottom there, their ranges where they are now. But that's a really important assumption, however. You need interest rates to stay at these all-time low levels today just to justify where asset prices are trading, just to justify the big gains we've had in recent years. And what worries us is, while that's probably the case, it's certainly not definitely the case. And there's a really nasty negative skew in that relationship. Just for markets to hold on to the gains they've had recently, sort of everything has to go right. Central banks have to do a very delicate act over the next year or two, manage an uptick in inflation while still keeping interest rates very low. If they're not able to pull that off, that's certainly a possibility. You know, where we'll probably be surprised is that interest rates shoot higher than we've all been expecting, and that would almost certainly lead to a pretty nasty pullback in the market. We don't think that correction is the most likely path ahead of us, but there's not a lot to like about that debt. Sort of everything has to go right just to hold on to where we are now. That's not a particularly comfortable place to be. While we don't think of big corrections, you know, the most plausible path for the few years ahead, our second concern, and again, this is probably a bit more subtle, really revolves around investors' expectations. Over the very long run, you know, the time that horizons you really need to measure things properly, global share markets, global equity markets have generated annualized returns in the order of 7 or 8%. And that's sort of a good rule of thumb to use when you're doing your own asset allocation with your own portfolio. In the last 4 or 5 years, global share markets have generated nearly double that, you know, 15+% per annum every year for the last 4 or 5 years. And unsurprisingly, during this period of sort of above trend returns, investors' expectations have been ratcheting up. You can see that in the survey data. We certainly see that in the conversations we have with investors. And unfortunately, just because recent returns have been really strong, that's not a particularly robust platform to forecast future returns on. Indeed, finance theory tells us, to the extent that these things are useful, the lower interest rates are, the lower your expected return should be across all asset classes. To say another way, for share markets to continue compounding away at 15% a year, every year forever, would need some sort of wholesale rewriting of what we understand about economics and finance, which you know, it seems like a tall order. So why does that matter? Well, for 2 reasons. Firstly, you know, as investors' expectations get ratcheted up, they generally take on more risk, and that worries us, mainly for those investors that possibly taking risks that they haven't quite fully thought through or appreciated. And then secondly, just to the stability of the market as a whole. You know, as a general comment, without trying to sound like too much of an old fuddy-duddy, it's probably been a bit too easy for a bit too long for people to make money in the market, just sitting there for some time now. And when you take that as take that proposition at a time when markets near their all-time highs, that's perhaps not the most comfortable place to be. None of that's to say we've suddenly become massively bearish in the market. Rather, I think from our point of view, it just means that we're tempering down our expectations about what we should expect from market returns. That's one part of our portfolio, and we certainly expect them to be a bit more subdued over the next few years than we've realised in the past few years. Helpfully, pleasingly for GVF, that's only one part of what we do, and probably a smaller part of what we do. It's very much a secondary concern. We have the second source of return, the unlocking of the value. That's further the key premise of our fund. And on that, I might jump to the next slide.
Sure. The first line.
Yeah, not quite. Yeah, so look, as I was saying, so obviously 2 parts of our proposition. There's the returns we get from the underlying market. We run a very conservative portfolio deliberately, so we don't expect a lot of returns from our underlying portfolio. On top of that, and more importantly, is all the returns we generate from unlocking the value in what we do. And pleasingly, we're still fully invested, even using a little bit of leverage, still finding lots and lots of exciting things to do. Just to maybe frame the situation for us quickly. Last year, we had a big event in the market, big crash around the arrival of the COVID-19 pandemic. And for us in our little sort of small universe, it was basically a big dislocation event. It opened up this enormous array of new opportunities for us, fantastic arrival of trades that we hadn't found for a long time, and trades that we were putting on with much, much higher return targets than we normally expect. We have been very busily harvesting all of that value on behalf of shareholders for the last 1.5 years now. It's been a terrific run of performance. You know, touch wood, we've now done 19 months in a row without a down month. What I wanted to say is that, you know, through that time, the opportunity set has begun to normalize. So things are not as exciting today as they were a year ago. We estimate they're still a good 20 to 30% better than they were pre-March of last year. So it's still a better environment overall for us to be playing with, but things are coming back down to normal. And we would expect that. We witnessed that investing through the GFC, 2008, 9 and 10, and we're sort of seeing that same trajectory today. We are still finding really exciting things, and above average exciting things, but we're having to look a bit harder, and they're generally into a more illiquid names, or names that are a lot more complicated, more complex, where we have to really roll our sleeves up and dig into them. One simple way to show that, hopefully, is these charts that we're going to put on screen now. The data we're about to look at is just for the UK market. So this is one of many markets we invest in around the world. The data in the UK is probably the best, and it's certainly the easiest to work with quickly. So that's why we've just used UK data for this presentation. But I guess the comment to remember is this: the shape of these charts is essentially the same, no matter if you're looking in Singapore, Canada, or Australia, or wherever else we invest around the world. The first line here shows the average discount on the closed-end fund universe in the UK. So that's a key sort of stomping ground for us, key place that we play around in. You can see that it spiked down sharply during the COVID sell-off. The whole universe just became incredibly cheap for a short period of time, and we were really spoiled for choice in terms of trying to find opportunities. Since then, it's moved back higher, and today we're probably not that far off from where we were before COVID arose. The problem with looking at charts like this, and I know a lot of people in the market do, is that looking at an average can be very misleading. We don't invest into average assets. We're small, we're nimble, and our whole philosophy is cherry picking the most exciting things in the universe, not just only having large amount of assets and just owning the average asset or owning the index. So the second lines here show a one standard deviation around the mean. They essentially show the dispersion of outcomes, or how the range of discounts out there has widened considerably since COVID. You can see those bands were much tighter than they are pre-COVID than they are today. And that chimes very much with how we're seeing markets. While things have begun to normalize, and we are having to look a bit harder to find really exceptional opportunities, in that bottom right-hand corner, there's still lots of exciting things to do. We're still finding, discounts on assets or funds at, 20% level, as opposed to, say, a 14 or 15 that we might have expected 2 years ago. So on top of the fact that we're still benefiting from the upheaval and the dislocation from the correction last year, we're finding other really important thematics as well. One of them is this private equity thing, which Mark's going to talk about in a little bit. And as always, and it's a thing we don't talk about too much because it's sort of our proprietary IP, but our trading business just rolls on through time. That hasn't really been affected by any of the COVID iterations, and we're still finding really interesting things to do there. I might just finish and say, look, the opportunity set will normalize at some point. I guess we've been guilty of, maybe not guilty is not the right word, but we've been very keen to highlight to everyone for the last 2 years that it's been an extraordinary time for us, and that we were really excited about what was going on. Probably by this time next year, we'll be getting on the phone and saying things are just back to normal or back to average. We're certainly not going to be packing up and going home at that point. Before the arrival of COVID, we'd run GVF for 6 years. And it was probably quite a tough time to have launched a fund. Like in hindsight, we launched GVF in 2014. All of the really juicy value from the GFC had been squeezed out of all the markets that we play around in. And since 2014 through to the start of last year, 2020, it was a pretty thin environment if you were just looking at those averages, or if you had a lot of money trying to put to work in the universe. Despite that, we've generated in the order of 7% a year of outperformance, so 7% on top of the market returns we get. And then, of course, if we were to include the period since March of last year, when the opportunity sets really opened up for us, that outperformance number rises to about 9. So whilst we've had a wonderful run, things will normalize, and that's not going to stop us being hopefully very excited about what we do and finding interesting opportunities. But just to finish off, so thank you everyone for making some time, and to say we're always here. So no question, big or small, is too much, please email, call, or however you would like to get in touch.